Hello and welcome to this special programme on the latest non-farm payrolls report. The headline figure for the United States is expected to come in at 175,000. That's for the month of February. We'll also be paying close attention to any revisions to last month's reading for January, which came in higher at 225,000. The unemployment rate, meanwhile, is seen coming in at 3.6%. That's in line with the prior month. And the average hourly earnings figures are expected to hit 0.3% month on month and 3% year on year. Let's have a quick check now on the very volatile markets, starting with Europe. We can see that there are major moves to the downside for the major averages across Europe, including in the UK, with the FTSE 100 down by 3.79%. But it's the France 40 cash that's leading the leg lower to the tune of 4.2%. Let's have a check now on US markets on the IG platform. Just over an hour to go until the start of the cash session to round up the week stateside. We can see that we are looking towards losses for the major averages. The US Tech 100 cash looks to be the main loser. It's also seen as the NASDAQ. It's down by 3.78% on our platform. And here's a quick check on the US dollar crosses. We can see that the dollar is trading a bit lower against the euro and against the pound, as well as against the Japanese yen. Sharply lower, in fact, against the safe haven currency in Japan. They're down by 1%. Now, let's check in with IG's senior market analyst, Josh Mahoney, for more on what we're expecting today. Josh, now we had the ADP private employment report on Wednesday, which is often seen as a precursor to Friday's non-farm payrolls report. That came in at 183,000, touch better than expectations. So does that set us up for a better number today?
Yeah, I mean, look, when you're looking at relationship in terms of the ADP to the Friday headline number, sometimes it looks like there's a relationship, sometimes it looks like they're completely unrelated. So anything that you do see on the Wednesday is always taken with a pinch of salt. But that being said, the interesting part about this is going to be how much is this whole coronavirus issue playing into the US jobs market. If you were to look at the reading on Wednesday, you would say probably not much. In actual fact, the big move came from the prior reading. We saw a massive write down in the January figure. And in terms of the February number, you know, it was relatively reasonable in the 180s. And that's around about the kind of area, the 180s, 170s that we're looking for the headline figure this time around. So certainly there's going to be some focus on the previous reading of 225 for today's number. But certainly I think the key thing here is, are we seeing any sort of knock-on impact? You know, of course, the major economy that's been suffering throughout February has been China, and certainly that's been spreading over the last week and a bit in particular. But are we seeing any sort of knock-on impact in terms of Chinese suffering economically and how that could impact on US jobs? And I think progressively, you know, there's a lot of people saying that, you know, this meeting today or this release today, you know, is irrelevant. I wouldn't necessarily say it's irrelevant. It, to me, feels like the beginning of a phase where it becomes more relevant than ever, because we're going away from a phase where it's like, okay, well, you know, we're creating a decent amount of jobs, unemployment continues to be low. We're now moving into a phase where we're trying to quantify exactly how much this coronavirus issue is really stunting growth and jobs growth in particular. So certainly, this is a precursor to that. It's more about finding out if there is any sort of knock-on impact for February. But as we move into the likes of March, and I think the numbers are really ramping up in terms of cases over in the US and globally, that's when we're starting to see the jobs numbers really reflecting exactly how much this coronavirus is or isn't impacting the economic picture.
All right, so can you talk to us about how to really trade this payrolls report? Because there seems to be so much volatility in the markets. We're seeing major moves to the downside in terms of the US averages on the IG platform ahead of the open. We're also seeing the US dollar, as I mentioned, down by 1% against the Japanese yen today. It's at a 6-month low. It's also, I think it's at a 2-year low against the Swiss franc, so against those safe haven currencies. Where's the opportunity, do you think?
Look, I think what we're looking at the moment is the beginning of a wider crash in terms of stock markets, you know. So I think in terms of being able to potentially set us up for further downside, any sort of rebound that we might get off of this jobs report, to me, is an opportunity to sell. Now, like I said, this could give us a little bit of a hint as to what this coronavirus issue is doing to the US economy. But by and large, I don't think any move that we see off of this payrolls release is going to particularly last. So let's firstly get ourselves onto the down. We can see here this drop down below 25736 provides us this double top, and therefore if we did see any sort of short-term rebound, for me that's likely to be sold into as we come towards this 25954. So as long as we remain below that level, I'm expecting us to continue this selling. Bear in mind, back end of the week at the moment, so we are looking at the potential for.
All right, I'm just going to interrupt you there because we've got the numbers. It's 273,000 for the headline non-farm payrolls figures for February. That's a beat on expectations for 175,000. Meanwhile, last month's number was also revised higher to 273,000. So in terms of the headline figure, this is certainly a massive beat on expectations. Average hourly earnings, that of course a gauge on inflation, bang in line with expectations, 0.3% month on month, 3% year on year. Let's check in on the unemployment rate, a touch better than we were expecting, 3.5% versus forecast for 3.6%. Josh, can you give us a sense of what's happening in terms of the markets? I'd imagine that we're seeing a bit of a boost higher there on the fact that we have seen this massive beat in terms of the headline number.
Okay, so this, for me, is good news because I think that the economic picture is going to decline. So the fact that we've seen this huge outperformance, and I don't think it's necessarily going to last, could potentially give us this counter-trend move for us to be able to move against. So stock markets, you're barely seeing them move higher. This is the hourly time frame for the Dow. Let's go into something shorter. This is the 5 minutes. You can see we're barely moving higher. That's a massive beat, you know. Certainly you'd expect to see a bigger move. An interesting move is coming into play here for gold. Now, gold's been an outperformer because of the fact that we're, number one, people want to get into havens. Number two, you're seeing the devaluation of currency through a global push towards more monetary policy easing. We're seeing some downside here. Now, I think that we're going to see further upside coming into play. We've been seeing incredible gains over the past couple of days. Now we're moving lower. I think, you know, if we were to see a break below this 1668 mark, then maybe it starts setting us up for a wider retracement. I don't think that's going to happen. I think this is going to be a really short-term move. I think it's going to be very difficult to shift people's sentiment away from this expectation of significant declines. You can see the 61.8 holding up at the moment. If we move into this zone again, I think that's going to be a good long opportunity for gold. And then let's look at some of the currencies. We can see in terms of euro dollar, that's been having a real rip. The differential between the likes of the euro and the pound against the likes of the Canadian dollar, the US dollar, those currencies that have still got a long way to move in terms of monetary policy. You're seeing 50 basis points from Bank of Canada and the Fed this week. First, the likes of the pound and the euro, where we've got the ECB and the Bank of England, which have got such low interest rates, they don't really have much in the way of room for manoeuvre. And that's why we're seeing this massive outperformance in terms of the euro. Are we seeing strength in terms of the dollar around about this release? Not particularly, and if anything, this shows you how incredible this belief is at the moment that we're going to see continued weakness in terms of the economic picture. We're likely to see continued easing in terms of central banks until you see the likes of those major sort of outliers, like I said, the Bank of Canada, the likes of the Fed, the RBA. They're all likely to see interest rates coming back in line and moving back towards zero if we continue to see the economic picture decline. So at the moment, we're not seeing much by way of dollar strength. We're not seeing much in terms of stock market strength, and that really does point towards further downside, much in the same way as what we saw yesterday in terms of oil prices. Oil, of course, we're talking about this cut in terms of OPEC, yet oil moves lower, and that really shows you if you're not seeing a move in the right direction off of these big moves, a huge number in terms of the payrolls figure, then that really does point towards the possibility of another significant move in the direction of the prevailing trend.
Yeah, I think it also shows the fact that the market has trouble digesting more than one thing at once, and at the moment it's very focused on the concerns around the coronavirus, and the fact that we have got this beat in terms of the unemployment and the wage data, the market's pretty much having a muted reaction there. One of the debates that's being had is the question about whether or not this is going to be contained to the markets. Of course, we're seeing the major averages stateside in correction territory, the S&P down by around 13 or so %. But is that going to then lead into, say, a recession? Because we have been in this bull market, we have been in an upswing for over 10 years now. Is it time for not only a market correction, but an economic downswing as well?
I would say so. I mean, look, ultimately this is pure conjecture. I don't necessarily know whether they're going to be able to control this. They could announce tomorrow that they've essentially somehow fast-tracked a vaccine and that they're going to be able to get on top of this. But from everything that I've read, that seems very unlikely. That's going to take a long period of time. And as this expands out throughout the world, you're going to be looking at the experiences in the north of Italy as something that could happen throughout many areas within Europe. And of course, if you're looking at major cities, then that could have a massive knock-on impact in terms of people spending, in terms of tourist numbers, in terms of travel, you name it. industries across the country and across the world are likely to be hit hard. So I think the economic picture really does look pretty dour. I think this is likely to be the beginning of the next recession. But again, this is me speculating to something that actually we don't necessarily know how this is going to progress. You know, I am certainly very bearish within this, and in actual fact, I think that if you're looking at this at the moment, whilst it seems like things are moving very quickly, this is actually unraveling relatively slowly. You know, every day we see numbers gradually rising in terms of these figures. But if you look forward maybe a month, you know, a month ago we were talking about around about 227 people outside of China with coronavirus. Skip forward a month and all of a sudden you're over 15,000. So, you know, for me, that rate of increase, we start looking towards the next month, I think we're going to be looking at a massive month in terms of the world economy, in terms of being able to control this, and in terms of markets. And that's why I think, despite the fact that we've already seen significant downside, and you're going to probably see some people say, you know, buy the dip, this is cheap for stocks. You know, we've come a long way, and certainly in terms of US markets, and we've got a long way to go in my mind if we continue to see this virus spread and we see a number of cities and major areas and events and travel all start to shut down. I think this could have a massive implication for the economic and market picture.
Yeah, because we are sort of about 15% away from those highs, but if we compare where we are versus the lows at the bottom when we're at the height of the financial crisis, we're still about 75% above those lows, so you can kind of see it from both points of view. Now, I wanted to ask you about monetary policy. Of course, there's been a lot of focus on the Fed this week with its surprise 50 basis point cut, the Bank of Canada as well, the RBA in Australia, and focus next is on the ECB, and it's really the first test, isn't it, for Christine Lagarde?
Yeah, I mean, look, I don't really see what she can do. When she came into power, everyone was talking about, you know, there needs to be the shift away from monetary policy and towards fiscal policy. Her job is going to be more like a politician, to go and speak to the leaders of the countries within the Eurozone and try and essentially make them spend more. And so now all of a sudden we're having this crisis and people are saying, what the ECB going to do? They've already got QE, they've already got rock bottom interest rates. And so, you know, in the same way as, you know, we'd been talking earlier in the week and saying, you know, this idea that somehow 50 basis point cut off of, you know, a mortgage or a loan is somehow going to instill confidence that this virus that spreads around the world could end up killing people and keeping people away from work. It's just not going to happen. And so arguably to take something from around about 0% and then cut that further, I don't necessarily know that that's going to make much of a difference. I think it's going to be in the hands of these governments, and they're going to have to start ramping up fiscal spending if they're somehow going to help a little bit. I don't necessarily know that they're going to be able to mitigate it completely. But certainly I think, you know, from the perspective of small businesses, that's where my worry is. There's a number of companies that are going to be hiring people that can't go to work. They're going to continue to have to pay them. They're not going to necessarily have customers coming in. And so that squeeze is something that the governments are going to really have to keep a hold of and keep on top of as they try and avoid this idea that a number of companies are going to go bust as we get through this sort of short but sharp drop in terms of output.
Okay, I wanted to ask you a technical analysis question as well. If we could have a look at the chart of gold, because that's been pretty interesting. Obviously, it's been in a bull run really ever since the latter half of last year. When we had a lot of that volatility over the last couple of weeks, it wasn't always gold that benefited on the day, but broadly, it does look like it remains in an uptrend. Is that a good trade, long gold, given the fact that it is already at 7-year highs?
Yeah, I mean, look, we are all trying to work out exactly why we were seeing this move towards the downside in terms of the gold at the same time as seeing stocks sell off at a point. And you look back historically and you actually see that, you know, generally when you see these initial market crashes, people are scrabbling to try and get money
everyone sells everything, don't they?
So they sell everything. You've seen the same kind of thing with some of these cryptocurrencies, which often have been perceived as anti-fiat, you know, so exactly, digital gold. And I think you're likely to see, and you are seeing, that move towards these havens once more, and people moving away from, you know, people hate this idea that central banks devalue their currency and there's this currency crisis. You know, I don't want my currency devalued because that's where I'm holding my cash or where I'm holding my stocks or whatever, you know, so people want to move into these kind of things. The thing about today's release, I guess, is that, you know, this overwhelming story is about continued easing from central banks. And in actual fact, you know, I mean, you're not going to get much higher numbers in terms of a jobs report than this. So I guess the question mark now is, what are we going to see from the Fed? We've got another We've got a meeting later this month. They've already eased by 50 basis points. Is this going to be something that tells them, actually, you haven't seen the economic data to tell you have to ease? You've already eased by 50 basis points. You shouldn't necessarily be doing much now.
Yeah, and the market's pricing in a 70% chance of another 50 basis point cut in a couple of weeks.
Yeah, I mean, I don't. It's difficult. You look at what happened in terms of post-referendum in the UK, and Mark Carney decided to cut immediately after the decision. Now, nothing happened in terms of the economic picture. People didn't suddenly just flee the country. And it took a long time before we got to these cliff edges before the economic picture started to sour. And people lost a lot of respect for Mark Carney because of the fact that he didn't rely on data, and he just made his judgment that, like, oh, Brexit's bad in his opinion, and therefore I'm going to cut. Are we seeing a similar kind of thing in terms of the Fed? They don't necessarily know this is going to really spread throughout the world. They've already cut by 50 basis points, and less than 2 weeks later they cut again. This
certainly not showing through in the data yet, and that's pretty clear from what we're seeing today. From
So
payrolls.
are they reliant on data, or are they just reliant on trying to forecast a health crisis that they don't necessarily know what it's going to do? So, there are some question marks about whether that theme in terms of, we're going to see another bumper rate cut from the Fed, whether that theme is going to go away a little bit and that we're going to see a little bit come off of gold. Like I said, though, that key level in terms of gold is going to stand as the notable level to watch. And you can actually see that we're moving towards that 1668 mark. If we do break below that level, then we're going to, I think, see a little bit of the unwinding of this idea that we're going to see a massive bumper 50 basis point rate cut again from the Fed later this month. So certainly that's going to be the key level to be watching, 1668, as we potentially start moving into a little bit more of a consolidation phase as people try to understand what the Fed's going to be doing next.
All right, let's just recap the numbers once again before letting you go. It was 273,000 for the headline figure for February versus expectations for 175,000, 0.3% for average hourly earnings month on month, 3% year on year, both in line with expectations. The unemployment rate coming in at 3.5%, a touch better than expectations for 3.6%. Now that's all we have time for today, but before letting you go, let's have a quick last check on the markets. We can see there that the FTSE 100, the DAX and the CAC all remain in negative territory and have failed to get a boost on the back of this better than expected non-farm payrolls report. The CAC down by 4.3%, leading the leg lower. And we can see that it's the US Tech 100 cash that is down the most so far in today's session, with around 45 minutes until the cash open, down by more than 3.5% on the IG platform. And just a very quick check on the US dollar as well. We can see that the dollar is lower by 0.75% against the common currency in Europe, down by 1/3 against the pound, and it's trimmed those losses very slightly, now down by 0.8% against the Japanese yen. Thanks so much for watching this special programme on February's US jobs report, and thank you to my guest, IG's senior market analyst Josh Mahoney. I'm Victoria Scholar, and have a lovely weekend.